Okay, I think we're live. We will just start the timer and we'll start the webinar, the web class, in about 30 seconds. Just giving a bit of time for us to make sure everything's working okay. Seems to be the case. About another 20 seconds or so. Okay, great. Let's make a start then. So welcome to this live web class called Predictable Profits in Casualty Insurance. I'm going to be with you for somewhere around 40 minutes, I think, today, going through this web class, which we have been running as a webinar through Zoom that people sign up to, but we thought we would put it out there as a live today and see if that got some engagement from some other people. So just a few things to be aware of. There will be time for Q&A at the end. We will be monitoring the comments, but I'll probably just leave those for the moment until the end and answer questions then. Please do put questions into the live stream comments, and we'd really appreciate any likes, celebrations, loves, insights, or curious buttons being clicked as well, because that will help to spread the word for anyone else that might be interested in seeing the web class. So for those of you that don't know me, my name is Christian Harris, and I'm the founder of Slip Safety Services. We prevent slip and fall accidents in busy public buildings. I'm also the host of the Safety and Risk Success podcast. Some of the things that my team and I have done, just to give a bit of background and give a bit of credibility, hopefully, to what we're going to be talking about today. We've supported over 5,000 client sites, and typically, as you'll see later, we see a reduction of around 50% or more in slip and fall accidents, injuries, and claims in the sites that we work with. I myself have worked in some very high-profile cases. Perhaps the most high-profile was the one mentioned here, which was Stanley May, who slipped and fell in a co-op store in Truro in 2015, banged the back of his head, and unfortunately passed away as a result. And I was helping that investigation for co-op. And at last count, we are preventing or stopping around £10 million of slip and fall claims a year in the UK. The reason we've got Ronaldo up is because Ronaldo was last transferred for about 99 million, I think it was, from Real Madrid to Juventus. And so about a third of Ronaldo is 30 million, give or take. And if you'll permit me, I'll just share a quick story about myself, because I think this helps to give a bit of context as to why I'm involved in this world of risk management and safety. So if you cast your mind back to the summer of 2012, it was the London Olympics, and I live now in London and lived then in London, actually not too far away from the Olympic Park, as it happens. I lived kind of in between Islington and the Olympic Park. And it was before kids, so a Sunday morning would mean a lion. Those were the days. And my girlfriend at the time, now wife, would go and get a croissant or something from the deli around the corner, typically. This particular Sunday, we decided it was a nice day. We thought we'd go to Columbia Flower Market in East London and have a stroll around, grab some flowers, had some lunch at, I can't remember exactly what it was now, but it was one of these vans that you see at these typical markets in cities. And then we hopped in the car and drove home, and we decided that we'd call into supermarkets and grab a Sunday Times and some groceries for the week on the way back. So we drove and we parked in the car park of the Sainsbury's in Islington. If anybody's in London, you might know where that one is. Parked the car, rounded the corner, heading down towards the store on Tolpuddle Street, which you can see here. And that's the last thing that I remembered for several hours, because unbeknownst to me, a car was speeding around that corner far too fast, lost control, mounted the curb, and ran me over, which was pretty horrific. Not the best Sunday of my life, it's fair to say. I don't actually remember the accident, but my wife was stood, thankfully, to my right, and therefore the car didn't hit her, but she remembers it vividly, and there were lots of witnesses, of course, who saw it as well. That was me in the hospital later that day, not looking my best, although many fewer grey hairs than I do have now, to be fair. All in all, I was obviously unlucky that it happened, but I was lucky that my injuries weren't more serious. I had a broken collarbone, as you can see here, broken wrist. I've got some neck damage and a few things like that, but nothing, nothing that sort of has changed my life forever and ever, other than a few niggles here and there when it's cold. So, lucky but unlucky. And what this taught me, I suppose, was it really brought it home to me that an accident can happen at any time, and that an accident that isn't your fault can really, very profoundly change your life. I was already kind of starting my journey in this world of safety and risk by this time, but actually this really is what kind of has made me super passionate about this, because I've felt it and lived it and seen how bad these things can be, and so I kind of devote my time to trying to help people to avoid bad things like this happening to them, although not in the field of road safety in my case, but in the field of slips, trips and falls, which actually, if you look at the statistics, and we're going to touch on this later, are the biggest cause of accidents, of harm and of claim in pretty much most sectors and most countries around the world. So hopefully that just gives you a bit of background in terms of why I'm doing what I'm doing. So the objectives for this live are to discuss the insurance industry, specifically in casualty, and why profit has been pretty elusive. Look at what the levers are that we can pull to try to change that going forward. Look at some of the trends that are driving the markets and how those affect the levers. Think about a new mindset, so a different approach to the way we've always done things. Look at a framework around that and 5 philosophies. Give you some numbers to consider around that, because if you're in insurance, then you're likely to be interested in numbers and tangible results. And finally, go through kind of how we can help with a new product that we've been working on. So let's set the scene then. Casualty insurance. When I speak to the people outside the industry, they're always shocked to hear that insurers don't often make a profit in this line of business. I remember distinctly talking to someone involved in the leisure sector, and he was kind of pretty aghast about something his insurance company had done, and he sort of grumbled about all the profit they're making from me. And I said, oh, actually, they're probably making a loss from you for the last 10 years, which he was quite surprised by. But this is US data, but pretty much, UK, around the world, you're going to see something similar, which is a combined ratio in and around 100% in most cases. So what can we do about that, and why is that happening? This is kind of business 101, but if you think about profits, then we need to consider sales, so the top line. So what can we do to drive sales? What can we do about our variable costs, in other words, claims? What can we do around our fixed costs, our expenses? And that's what's going to drive our profit. So let's have a think about what's happening in the world around these areas. So if you think about sales first, obviously the main thing that comes to mind is the market cycle, and we're very much now into a hard market. Obviously casualty hasn't been affected as much as some other lines, but we're still definitely in a hard market when it comes to property and casualty. Now that's going to help us in the short term, because obviously our sales are going to go up. But in the long term, if we don't get the other elements of our expenses and our claims costs in line, then once the market softens, that might cause us a problem. So we might be able to have a short-term fix with sales, but in the long run, we need to do something more systemic, more sustainable to try to address this profitability issue. Let's think about expenses then. What can we do around that? And obviously, expenses, is only a relatively small percentage of total costs, but it's a fixed cost, and therefore, or more fixed anyway, and therefore, if we can do something, then that's probably sustainable. So, on the one hand, we're seeing inflation and the risks around inflation, obviously, particularly in Brexit times and things like that. But we might be able to offset that with some of the trends around globalization. We're going to be talking about technology later, and technology is enabling globalization and offshoring and saving of costs and things like that. So, even in our business, we have a couple of people that we use in the Philippines to do certain tasks for us because actually they do a really good job. They're very well educated, speak excellent English, work very hard. But for them, £7 an hour is a excellent wage, and we're getting a very high quality person for £7 an hour, whereas here for £10-11 an hour, we wouldn't necessarily get the same quality of output of work. So there maybe are some things we can do around expenses, but perhaps they're balancing off a bit. So that leaves us with variable costs, and if you look at the average pound of premium, then sort of 80p of that is going to be covered by this area. So this is the biggest chunk in terms of the costs that we can try to control. So what are the trends here? Well, I think a big trend that not many people have been talking about is demographics. So we're seeing people living later and later in life. And what does that mean? Well, it means that people are either working later in life or they're more active later in life and they're going out and doing leisure activities, for example. But either of those things introduce risk of kind of attritional types of accidents and claims, such as slips, trips and falls, manual handling, etc. But of course, if you're 75 and you fall on your hip, you're likely to suffer a break and a quite long and costly rehabilitation period. Whereas if you're 25 and you fall in exactly the same way on your hip, you probably just have a bruise, you dust yourself off and get on with your day. So the demographics and the baby boomer generation are driving almost a ticking time bomb of volumes and cost increases, which are coming up over the horizon. There's obviously the spectre of COVID, and we're not yet seeing huge volumes of COVID liability claims, but we are seeing some. Speaking with insurers, lawyers, claims handlers, TPAs, etc., we are seeing some volume starting to come through now. But I think the bigger effect of COVID is actually what it's going to do to the economy. And we all know that in times of recession, claims volumes go up. We also know that in the event of being laid off from work, the preponderance to put in a claim goes up as well. So we need to be wary of these things because there are some potential drivers of volumes and costs which are sitting there pretty presently in the roadmap that we need to confront. Now, if we look at a breakdown of claim costs by type, this data comes from AXA. It's from their website relating to 2018. The biggest cause of kind of health and safety casualty type of claims for AXA was slipping, 80 million. Manual handling was number 2, 30 million. So 110 million just from those two types of accidents, and then we'd have trips on top, and then some of the other attritional claims as well. So we're talking some big numbers here. But I suppose the question is, why are we having these types of claims? And what can we do to try and address that potentially? So if you think about some of the problems that are driving these types of claims, I think within customers, there's a mindset and a skill set deficiency is probably the best way of putting it. So what do I hear a lot? I hear things like, it's okay, that's why I've got insurance. Or, a wet floor is bound to be slippery. Things like that. What can I do about it? And that's a mindset where people are accepting of claims. They don't understand why any claim is bad for their business. And so they look at it very simply. They don't understand the true hidden cost of accidents. The fact that, for every pound of insurable cost, there's, the HSE would say, between £8 and £36 of uninsured hidden costs that a business has to pick up as well. So people don't understand that. Because they've kind of got this mindset problem, they don't therefore invest the time or the effort or the energy into creating the skills and the systems and the frameworks to solve these problems. And so we kind of get this vicious circle where we don't think it's a big problem, we don't think we can do anything about it, therefore we don't really try to do anything about it, and therefore we get claims. But then we don't think it's a problem, and so we don't do anything about it. Or what we do, or what we see is not necessarily that we don't do anything about it, but that what we try is very superficial, I think is the right word. So, I often get a photograph sent to me of buildings with 5, 10, 15 yellow signs scattered around on the floor, as if that's going to suddenly stop a problem, or if that's going to help them when it comes to defending a claim. And actually the reality is that it won't. So because the insured clients feel that they don't really need to improve, they don't really do much, the volumes stay high, and because they're not doing much, there's not much evidence, and so we have to pay out claims. It's amazing how often clients will berate insurers for saying, for not defending a claim, but you say, well, what evidence have you given them to defend the claim? And then they draw a blank. Another problem is these types of claims are massively thinly spread. So this is another thing that drives the mindset, because actually if you're an office building, you might only have a one slip and fall claim every 3 or 4 years. But actually, if you're an insurer, you're seeing tens of thousands of these offices, and therefore actually the cumulative effect is massive. But people don't get that because they're so thinly spread. But one of the challenges of these accidents and claims being thinly spread is that kind of a boots on the ground approach just isn't effective, because it's impossible to go and see enough customers to make a big enough impact. And that's why we have these claims year after year after year after year. So it's too costly. It's not scalable. It's kind of, 19th century risk management, you might say, or 20th century risk management. Let's be a little bit more diplomatic. And a third problem is the market is far too reactive. So we see a lot about claims defensibility. We see claims defensibility workshops. We see mock trials. Particularly from a broker perspective, there's a lot of emphasis placed on claims defensibility. But if we're thinking about claims defensibility, the horse has already bolted. The accident's already happened. In fact, several accidents have already happened. Several people's lives have been negatively affected before we even get to this one particular claim. And it's a bit like, the analogy I use is, think about your loss ratio, I suppose, as a reservoir, and that reservoir is filling up because there's a gushing river filling it up with litre after litre after litre of water, and having this kind of reactive approach, waiting until a claim and trying to do defensibility and things like that, are a bit like trying to bail out water from that reservoir with the Thames gushing into it with a bucket and spade from the seaside. It's just not robust. It's just not fit for purpose. It's just never going to get you anywhere. But yet we keep putting that approach into practice. So we've got to be mindful of the fact that reactive is always going to keep us behind the 8 ball. We're never going to get ahead of the problem. So we need to think about changing that. So again, use the analogy of the river. We've got to try and stop the river. We need to dam that river up and reduce the flow of the water into the reservoir, and then we can keep that water level under control. If we keep allowing that river to flow and flow and flow, we're never going to get our loss ratio under control. Stop accidents, stop claims, and lower your losses. So this is my belief, that if you want to be predictably and sustainably achieving profit in this line of business, you've got to move away from being reacted and being focused on, a small number of sites in quite a targeted way, to being proactive, getting ahead of the game. You've got to be at scale, and you've got to be preventative. So that's my belief. If you disagree, I'd welcome some comments at the end, and we can have a discussion. But if you agree, then stick on board, and I'll run through how I think we can achieve that. And now's the time to do this. I mentioned boots on the ground being sort of 20th century risk management. Well, now, the world is more connected than ever. We've got a thriving insurtech community doing all sorts of cool things, as well as lots of other technologies that we can leverage. So now is the time that we can actually do this. And we probably couldn't do this 5 years ago, but now we definitely can. How do we do it? So I've come up with a framework here, which I've called the 5 C's. So this is a model. And if you can take that statement I made about being proactive and at scale and preventative, and think about this as a roadmap to try and achieve it, this is going to help you to achieve those objectives. So I'll run through the 5 C's. The first one is communicate. So this is going back to that mindset challenge. We've got to educate clients on why better risk control is a good thing for them. So they need to understand that every claim is bad because they have to account for it. It goes on their claims history. It's going to affect their premium, etc., etc. And we've got to explain to them how best to achieve that. So we need to think about the accident iceberg that I referred to earlier, and the fact that the insured risk is quite small compared to the total cost of risk. And the outcomes for the client of achieving this are summarized in what I call the 4 Ps. So if you can achieve a level of protection of your staff, they'll give you better performance. That's going to drive profit, and then that will give the business the power to do more meaningful things in the world, from growth to hiring to new products and new markets, or social or charitable impacts. The next C is create. So we need to produce or find, I suppose, some tools, tech tools that are scalable and that will actually prevent accidents and claims from happening, to start to lower the volume and to start to dam up that river. To do that, I've alluded to this before, we've got to stop being superficial. We need to go deep into subject areas and really make an impact. I use the expression inch wide, mile deep quite often. So I don't know if you've seen this before, but the Last Supper on Zoom is a great example of how tech's changing the world, even as we speak. And I mentioned, we've got InsurTech UK and other InsurTech communities springing up. So get involved with those and see what there is available to you. So what does P&C stand for? Prevention, not claim, I think, rather than property and casualty. I know it's not technically P&C, but there we go. Next is capture. So this is all about recording what's going on and creating digital evidence. So that means you can start to defend claims, but it also means you as the insurer can actually get some certainty on what the clients are actually doing. So rather than they're saying we're doing this and they're saying they're doing that, you can actually start to see what's really going on. So we're moving away from the typical handwritten housekeeping daily check sheets, for example, which are often suspiciously filled in the same handwriting. And we're moving towards another maxim I use a lot, proof, not promises. So evidence-based cleaning, capturing things in the cloud, digital timestamping, and all that good stuff, so we can really robustly prove what has or hasn't been done. The next C is clarify. So this is all about getting data, and I say insight-led there, and perhaps I should change this, because I'm not a huge fan of the word data to some extent, because I think data on its own is worthless. You know, you need the insights to go with the data, otherwise the data is just figures. But you know, if we can get really hyper-targeted insights as to what's happening in the clients and how that risk is evolving and shifting and changing, we can start to make some interesting underwriting decisions. So we might learn that a sector that we thought was quite high risk, actually, if we implement some solutions, we can dramatically change the risk profile of that kind of sector. And therefore, we suddenly open up these opportunities to write business that we didn't want to write before, for example. You know, we've all got huge amounts of ability in our pockets to be creating and sharing data, remember. And you know, what we should be doing is number 2 here. We should be using historical data, using some algorithms, producing a model. We should be moving to new data, therefore modeling and predicting. But the problem is, in reality, because of the historic approach we've taken, as I said, being too focused, being boots on the ground, we don't really have the insights data historically to know what to do. We're still just guessing. You know, we're still just looking at sector. We're looking at averages. We're looking at, you know, here's the likelihood of a slip and a fall claim cost. We'll add on 10% margin and hope for the best. And that's not going to be good enough if we want to be achieving profits on a sustainable basis. And care. So this is all about shifting the mindset internally to being a true risk partner. So AXA XL talks about moving from payer to partner, which is an expression that I really like, because actually, you know, we should all be sitting on the same side of the table here. You know, the insurer, the broker, the client, we should all want the same thing. We should all be working together, but also some of the other stakeholders as well that are involved. You know, regulators, unions, cleaning businesses, FM companies, architects, you know, all these people. We should be having a holistic kind of risk partnership approach to achieve a virtuous circle rather than that vicious circle we talked about before. Get around the table and working together. Also think about that from the perspective of expenses. So, you know, what's the cost of acquiring a new customer versus retaining a customer? If you're working with customers on a partnership basis, they're likely to stick with you for the long term, and therefore you haven't got these sales costs. So that's another way of reducing your costs potentially as well. So if we can do that, if we can leverage technology, if we can implement the 5 Cs, and if we can do that at scale, what outcomes are we going to get? Well, straight away, we're going to make our clients' buildings safer because we're going to be preventing accidents from happening and therefore stop people from getting hurt. So, you know, straight away, you can feel good about that impact that you'll be able to make in your clients' businesses. But in the long run, we're going to be seeing profitability going up. We're going to really have some huge amounts of data and insights. We're going to be able to do some interesting things around market positioning. And of course, we're going to be creating partnerships and customer relationships that are there for the long run and really working together as a well-oiled machine. So it's all about a new mindset and that producing some new results in summary. So that's the theory. Let's have a look at some numbers if you're still with me. So let's think about the traditional approach then to risk management. So, you know, most insurers have a risk management function. What do those people do? Well, they go out and they do surveys and they visit perhaps 2% of clients in any given year. So that means we've got 98% of clients with no survey, very few data points, very little insight, and very little exposure. But again, if we look at slips and falls, these slips and falls aren't just happening in the 2%. The vast majority of them are going to be happening in the 98%. So if we're only focusing very narrowly on that 2%, we can't expect to be shifting much around our biggest area of cost. The good news is that you can stop slips and falls. So these are a selection of outcomes we've worked with clients to achieve. Different sectors, different environments, very much wet areas like poolsides and bathtubs and shower trays, through to busy public areas like train stations. And it is possible to dramatically reduce the number of accidents and claims. Let's do a bit of maths then, if we think that about trying to move from reactive to proactive. So if we look at that traditional model, we're going and visiting 2% of sites. And if we're thinking about slips and falls, my experience is that, a generalist health and safety manager in a business, just as a generalist risk control surveyor in an insurer, is not going to be diagnosing that problem 100% of the time correctly. So if we said, 1 in 10 of those sites then gets diagnosed correctly when it comes to slips and falls, we've got 0.2% of your insured sites being identified. If we then look at the averages of about a third of claims, both by volume and value, being down to slips and falls, if we then were to put in place our own practical hands-on, boots on the ground work and reduce those by 50%, we're going to make a big impact in those customers, but that's only a very small slither of customers. And therefore the total impact on the claims experience is well under 1%. So let's go back to that AXA data, 80 million of slip and fall claims a year. Let's multiply that by the impact we can make, and we achieve a saving of £27,000. Doesn't seem too much for all of that work. Plus, we've got to consider the cost of delivering the risk management to those 2% of sites. And that's a big cost. And so that means, and this is, I don't know AXA's combined ratio on their casualty book. The number here that's true from AXA is 80 million. The rest of it is assumptions from me. But if they're anything like much of the industry, then that's going to lead them to have a combined ratio, in and around 100%, let's say. What about another way of thinking about this? So what if we could invest £25,000? What if we could use that £25,000 in a digital and scalable solution that we could give to 100% of our customers rather than 2%? But what if, we don't expect that to achieve a 50% reduction because it's a digital product, a scalable product. It's not a hands-on, boots on the ground piece of work. But let's just say that rather than a 50% reduction in accident and claims volumes, that decreases by 2%, just as an illustration. Let's go back then to the AXA numbers. We start with the same 80 million. But if we can reduce that by 2%, that's 1.6 million. I think you'll agree that sounds a bit more like it. We can save on some of those other risk management expenses as well, I believe, as part of this. Minus our 25k investment. And again, I don't know AXA's combined ratio, but if we're saving 27 grand and incurring all of those costs on the one hand, or saving 1.6 million here and saving on those costs, then clearly the combined ratio is going to be in a much better place using the latter model with the digital and the scalable and the preventative actions. So if that sounds something of interest, something you'd like to think about more, when it comes to slips and falls, my specialist area, then we've developed a product that might be able to help. And it's no coincidence that I gave you a figure of 25k, because that's the cost of the investment for this product for a year. It's called the Safer Portal, and basically I've had 10 years, as I said, in this field, so I know what works. I know what people need to do to reduce risk, and so we've deconstructed all of that. We've bundled it all up into a digital product, which can be given out to literally every single insured client, and we'll, as I'll talk you through in a moment, give them the frameworks and the tools to prevent accidents and claims, but also lots of data and insights for you guys, and be tracking all of that activity to produce defensibility evidence as well. So it's all about trying to protect your loss ratio by reducing accident and claim frequency, driving up defensibility. This is what the customer journey looks like. So the first thing we do is, going back to that mindset challenge we mentioned earlier on, we influence the customer. So we need the customer to understand what's in it for them, in terms of what do they get out of reducing the risk and reducing the frequency and the cost of these types of accidents and claims. So we need them to understand that. We need them to understand and buy into the fact that these accidents and claims aren't inevitable. And we give them a framework which has 6 areas called chimes, which is basically the 6 reasons why people slip and fall. And that's kind of the roadmap that we give them. The next thing we do is we diagnose where they are. So we've developed a digital diagnostic tool called the Slip Safety Scorecard. This asks them 45 questions, which takes about 5 minutes to answer. And they then get a score for each of those 6 areas of chimes, plus they get an overall score. And that starts to give them an idea of where they're stronger, where they're weaker, and therefore where they need to put their efforts to try to improve. They also get a 30-page report and a bit of a roadmap, and some hints and tips on what they should be doing to improve their score. For us, as in ourselves and an insurer, we're collecting 45 data points straight away then about that customer. So we know before they've even done anything else, is that a good risk? Is that a bad risk? Where are they weak? Where are they strong? Where are their areas for improvement? We can start to monitor that and track that, and start to learn, what can we do in a poor risk to turn into a good risk? Or what can we do to a good risk to turn into an even better risk, etc. The next piece of this is that we train them. So again, for each of the 6 areas, we give them some quite detailed and specific training on what they need to know and what they need to do to reduce risk in those areas. We then give them some training on defensibility as well. We check all of those modules with comprehension tests, and we obviously produce then digital training records, so we can prove in every single client site who exactly has had the training and who hasn't. We then move into the prevention phase. So for each of the 6 areas of chimes, we give your customer between 3 and 5 practical tools to go and implement in their business. So this isn't theoretical, this isn't just fluffy training. This is training to set the scene, and then it's saying, right, do this, do this, do this, do this, because we know what works. We've proven with our results over the years that we know how to reduce the number of these accidents, and we're giving our best thinking and our best actions that are achievable by the clients for 0 cost in the vast majority of cases, on what they can do to actually make the likelihood of slips and falls in their building much, much lower. And then the last piece is going into monitoring. So we're tracking the training, we're evidencing how they're implementing the tools, they're uploading photographs, they're uploading checklists, etc. So we're creating this huge amount of evidence, so that we know what they're doing on the one hand, but also in the event of a claim, we can go back to the other side with a huge wodge, figuratively, because it's all digital, but a big pile of paper of evidence of what's been done. We're tracking the outcomes, and so it's an end-to-end system here. You can see we're actually, putting together something very, very robust, very detailed, but very easy to use, very engaging. It doesn't take very long to go through this, but the outcomes and the investment in that small amount of time for the customer could be very, very profound. And the key point is, we can do that with every single customer. Every single customer can have that great experience. They're not reliant on an individual risk manager coming to visit them and what do they know or what don't they know. They're getting best in class information in this area. They're all getting exactly the same information because it's all done digitally. They're all getting the same tools. So we know that everyone has the same methods available to them, and therefore it's down to them to implement it. But if we can convince them that it's a good thing to do, then we should see some great, great results from this. In terms of the outcomes for the customer, so they're getting very targeted and specific, but bite-sized training and knowledge. Sorry if you can hear some kids in the background. My son's kind of home from school. They're getting proven practical tools to reduce the risk. They're going to see fewer accidents, therefore lower costs, both insured and uninsured. And they're getting a huge amount of defensibility evidence, which is going to be helpful to them in the event of any claims. For the insurer, clearly lower losses because volume's going down and defensibility is going up. We're going to create over 100 insight-rich data points per insured building. So that's a lot of data, but not just data, insights. Because we're helping the clients and we're solving problems for them and saving them money, we're strengthening and deepening relationships. And then, as I said before, there's a big market positioning opportunity here as well around pricing, turning around risks, and being able to write stuff that perhaps you wouldn't have written before. But also, there's a margin play here potentially too as well. So we think about that balancing of cost and risk as we talked about before, and we're trying to get to a more predictable and a sustainable level of profit. Let's think about weighing up those outcomes that we just talked about versus 25k investment for that product versus what's going on historically, and thinking about in the context of AXA. If that 25k investment secured a 2% improvement just in that slips and falls area, that would be a 1.6 million saving. So I believe there are some big upsides to this approach, not to mention all of the other benefits around data, positioning, customer relationships, etc. So coming to the end now, I think I've kept you slightly longer than I thought, but hopefully it's been useful. For me, I'm really known for caring passionately, as I hope you've seen, about something that maybe gets overlooked or people don't want to think about, which is what I do, what my business does is we make people feel safer. And if you've ever been the victim of an accident like I have, that feeling of safety is very, very powerful, and it's something you want to bottle up and would like to be selling. But for you guys, if you're an underwriter, if you're a risk manager, if you're in claims, if you're leading a casualty team, this kind of approach, moving to proactive, moving to digital, moving to scalable, moving to measurable and manageable, is going to leave you feeling safer because you kind of know that you're doing all you can, and you're going above and beyond, and that you're most likely to get a better outcome in the future than you've had in the past, and that is going to leave you feeling safer and feeling good about the decision you've made. But in turn, it's going to leave your insureds feeling safer too, because they're also going to see the benefits of this. They're also going to see the outcomes. They're also going to know they're measuring and managing, and they're going to feel safer too. And in turn, their staff, their customers will also feel safer because they're going to see what's happening. They're going to notice the differences. They're going to know that the environments that they're walking in are better than they were before. So all in all, we're achieving something pretty profound here, which is having a big effect on many people's lives. So that to me is the essence of what this is all about. So thanks for that. That's the end of my slides. I'm going to stop sharing. and I'm going to put my face on screen, and I'm going to just see in the live streaming here whether there are any questions or comments. Let me just open this up. This is one of the challenges of doing this on your own, is that you have to try to monitor things as you're going. So if there are any questions, I will see them in a second, and then I'll start to deal with them. If not, then I will say thank you very much for your attention. I'm just going to double check on LinkedIn because I'm not seeing any questions, which is good. Hopefully I've covered everything well. I think we're good. So let's wrap it up there. Appreciate your time and your attention. For me, as I said, we've got to be moving towards preventative, scalable, digital, moving away from reactive. If you're in casualty, you're likely to have some kind of issue with slips and falls. If you do, then I'd love to have a chat with you about the Safer portal. We've got a couple of insurers going live in June here in the UK, one Lloyd's syndicate as well. We're talking about this product to insurers around the globe. We do have limited capacity. We're not going to take on every single insurer. So, if that is something of interest, then let's chat. And hope you've enjoyed the web class and got some value from it. And we'll look forward to catching up with you soon. Cheers.